Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The stock market had a pretty rough last week, down about 2%, and the market's been pretty volatile during this earnings season. Now we're starting to get towards the end of earnings season, but I think we're starting to see some overreactions to the downside, which really gives investors some opportunities to buy some good values going into the end of the year. So I want to go through 5 stocks that I think are opportunities right now. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Check out fool.com/ASYM for the top 10 stocks to buy right now. Now, the first stock that I was really surprised at the reaction was Alphabet's earnings report. The core of the business, or the biggest pieces that are actually generating cash, search, YouTube, those businesses are doing extremely well right now. But what the market reacted to was the cloud business not growing quite as quickly or as profitably as a lot of investors expected. That is as Microsoft and Amazon's AWS just continue to crush it in the cloud business. A ton of growth, a ton of profits coming from those businesses, but Google's cloud is just barely profitable. That happened a couple of quarters ago, that it made its way into the black. And the fact that it's not growing maybe as fast or gaining as much market share as some of the competitors is really what investors were reacting to. But let's talk about the core business, because if you're buying Alphabet, the main business that you're getting is the search business, and then where you're watching this right now, YouTube. The search business revenue was up 11.3% from a year ago to $44 billion. YouTube revenue was up 12.5% to $8 billion. Now, they don't break out operating income based on those two segments. Google services segment operating income was up 26.8% to $23.9 billion in the quarter. So almost a $100 billion run rate for those core businesses. So I think investors are overlooking the strength in the core. If you can grow those core businesses by double digits, revenue growth in double digits is phenomenal at that kind of scale. And I think we're only starting to see the potential of a business like YouTube. YouTube has recently signed their deal with the NFL to do Red Zone on YouTube. That's going to bring in more customers. We're seeing the cable business die. Where do a lot of those customers go? Well, sure, some of them will go to Netflix for things like general entertainment. But if sports and other content ends up on YouTube and you start paying for YouTube Premium and then add-ons like different sports leagues or different channels, that could be a phenomenal growth business. And I don't really think that investors are really valuing that right now. So I love what the core business is doing. There's still a lot of upside in the cloud as that business grows. That's where a lot of the AI development is happening. And let's not forget about a subsidiary like Waymo, which has a lot of optionality. Now, the stock isn't necessarily cheap. Market cap, as I'm recording, is $1.6 trillion. Price to earnings ratio is 25. But I think this is one of the highest quality companies on the market today. So getting it at a 10% lower price than we had a week ago, I think is a great buying opportunity. The second company that I really like is Spotify. Now, Spotify is about flat over the past month, but their earnings report was really phenomenal. And I'm going to show some of the highlights here. This is their executive summary. You can see that total monthly active users were up 26% from a year ago. Premium monthly active users up 16%. Remember that they're putting a price increase in that hit late in the third quarter will really start to impact financials in the fourth quarter. But even before that, we saw a 10% increase in revenue year over year overall, an 11% increase in revenue. We're starting to see a little bit of momentum in that advertising business. But here's what's really positive for Spotify. They're really starting to get their operating costs under control. You can see that these operating loss went from between $200 and $250 million to positive in the most recent quarter. That really helped cash flow. And this is the other chart that they shared with investors. Sales and marketing costs down 18% from a year ago. General and administrative down 19%. So getting a lot more bang for their buck for the sales and marketing and general administrative, those operating expenses. That's something that really got out of control at Spotify, but they've really started to pull that back. That's going to improve the bottom line going forward. So if you have revenue growing faster than your growing expenses, those operating expenses, that is called operating leverage. And that means that Spotify could start to generate significantly more profit and cash flow than they have in the past. Right now, their run rate from a free cash flow standpoint is nearly $1 billion per year. You put those price increases in there, get a little bit of growth, and they could potentially be doing $2 to $3 billion in free cash flow a year. So a market cap of $31 billion, not cheap, but I don't think it's too expensive either, given the opportunity that Spotify has ahead and the improvements that they've made in the business. That really showed in the last quarter, but the market isn't giving a lot of credit for that. So I think, again, a good buying opportunity. The next one is General Motors. Now, this may not be a typical kind of company that you follow if you're interested in technology stocks, but GM is a phenomenal value. Right now, the price to earnings multiple is under 4. Just a phenomenal value if they can continue churning out cash. And I think that is going to be the case. And there's a few reasons for that. One, a lot of the investment in the auto industry in growth has gone into electric vehicles. That is happening not only at General Motors, but at all of their competitors. But what we've seen over the last few months is that supply is starting to exceed demand. You see that in Tesla reducing prices. You see that in commentary from Ford and General Motors saying that they're going to cut back some of their investments on electric vehicles. You're even seeing that with Hertz saying, hey, these vehicles are not as valuable and more costly than we thought they were going to be in our rental fleet. So I think demand is maybe not where it's going to be in the electric vehicle side of the business. Now think about the internal combustion engine side of the business, the core for General Motors, where they make most of their money is on trucks and SUVs. There's not a lot of new competition coming into the truck and SUV market. That means that they will be able to continue to command very high prices, keep supply limited, and have just phenomenal margins in that business for the foreseeable future. Again, we're not seeing demand for trucks and SUVs move to electric vehicles. The Ford F-150 Lightning not selling particularly well. I think Rivian is facing a number of challenges. And those are very, very high cost vehicles, much more cost effective to get into a ICE vehicle. And that's really going to help General Motors. They're going to be able to continue to churn out cash, invest in new products, some of those on the ICE side, some of those in the electric vehicle side, and then the cruise business as well. That is currently not operating, but I still think there's a lot of long-term potential there. And just this morning, we found out that there has been a tentative agreement with the United Auto Workers. So those workers are probably going to be getting back to work in the next week or two, producing vehicles again. So a lot of positives for General Motors going forward and just a phenomenal value stock. Let's not forget that they also bought back $1 billion worth of stock. Given the $37 billion market cap right now, that alone could add a lot of value to investors. So take a look at General Motors as well. The fourth stock today is MGM Resorts. So this is one of the major casino owners in Las Vegas. They also have 2 casinos in Macau and then a number of regional casinos. This has really become a cash flow business. They sold off a vast majority of their real estate to a couple of over the last decade. They did that at relatively high prices and then took that cash and either reinvested in the business, bought back stock, and now they just have to pay rent, which is an ongoing expense, but they have a ton of operating leverage because as revenue goes up, that rent doesn't increase at the same rate. So I love the dynamics for the business. Market cap is about $12 billion right now. Over the past 12 months, MGM has generated about $1.2 billion in free cash flow. So the market cap is about 10 times that free cash flow. But let's remember that we're not seeing a full recovery in Macau yet. That is a region that continues to recover from the pandemic. There were actual shutdowns in Macau, affected results late in 2022 and even into early 2023. So over the next year, we should see that cash flow improve on a backward-looking basis. They continue to buy back a lot of stock. I just love the operating trends for MGM. I think this is a great cash flow business, not yet a dividend paying business, but they are using a lot of that money to reduce their share count, and that should add value to shareholders over time. And the final stock is Coinbase. I think there is a lot more positive news coming out of the crypto and blockchain industry than we've had in years at this point. Coinbase has a market cap of $17.2 billion, has cash on the balance sheet of $5.2 billion, and is basically cash flow break even. So not using a lot of that cash, just continues to generate cash from interest payments. They're investing a lot of that money in treasuries, also have cash coming from the USDC token. But the long-term trend here is that there's a lot of innovation coming to the blockchain with companies using stable coins and smart contracts within their businesses. Vodafone, Mercado Libre, Visa, Shopify. These are all companies that are either accepting cryptocurrencies or stablecoins for payments or using the blockchain for business purposes. I think this is something that has been overlooked because the number go up, number go down, volatility of cryptocurrencies is really what caught the market's imagination in 2020, 2021, and even into 2022. But right now we're starting to get to a maturation phase. So this would be like the internet in 2002. Can you actually build a sustainable business on the blockchain? And Coinbase is a company that's building infrastructure for those kinds of businesses. Wallets as a service, stable coins, trading that ultimately happens in the background, prime brokerage, prime accounts for institutions. There are a ton of services that Coinbase offers that you and I may not actually see, but we may actually interact with in our digital lives. I think this is going to be a long-term growth trend. The stock has pulled back about 30% from its summer peak, and I think we may have some near-term catalysts if we get things like Bitcoin ETFs approved, which may even happen in the next few weeks. So Coinbase is a company that has a lot more positive going for it than you might think, given the media narrative around cryptocurrency and the blockchain. There is a lot actually happening with a lot of very big companies testing this technology out. Think about this as a technology, not think about this as a technology company, not just a crypto company, because there's a huge difference. And ultimately, Coinbase is going to be a technology company long term. So the stocks we went over today: Alphabet, Spotify, General Motors, MGM Resorts, and Coinbase. Which one of those is your favorite? Love to hear your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.